Hello and welcome to the MoneyMagpie Podcast. If you're watching this podcast, don't forget to share and like the video and tell everyone you know how fabulous it is. I'm Jasmine Birtles, founder of MoneyMagpie.com, and I'm joined today by Stuart Gray, a co-portfolio manager of Alliance Trust, working for the company's investment manager, WTW. He's also a senior member of WTW's portfolio management group, managing equity portfolios for a range of institutional clients. So thank you so much for joining me, Stuart.
Hi, Jasmine. Thanks for inviting me here.
So just to explain, Stuart, the way Alliance Trust works, so its portfolio is actually managed by an external fund manager, you and some others. Is that right?
Yes, that's right. Like most investment companies, there's a board of directors of Alliance Trust who are independent, and they appoint Willis Towers Watson, ourselves, to manage the portfolio. What's slightly different about Alliance Trust is that instead of picking the stocks directly, we actually appoint a group of stock pickers to pick stocks for us. So if you like, we assemble a team of stock pickers to pick the stocks, but we as the manager are responsible for putting it all together and managing the total portfolio of Alliance Trust.
Oh, right. And Alliance Trust, is clearly working well, because Alliance Trust has a really good history of giving value to its investors, particularly when it comes to its dividend. I know it's known as a dividend hero. So what do you think has been the main contributing factor for this particular success?
I think it's just the longevity of the time horizon of investing for the company. That long history really does focus it on what it uses as a strapline, which is investing for generations. If you have that long-term investment focus, it enables you to be patient as an investor and to use that patience to help you compound with returns and wealth more productively over a long period of time. And I think that is really key to the fact that it's been able to grow that dividend and keep raising that dividend year on year for over 50 years now. And it's been a dividend hero and generated a lot of wealth over a long period for shareholders.
Well, it really does. I'm just thinking, actually, what you're saying, how individual retail investors can take that idea. So you're saying taking a long view, being patient, that's better than just going for a fast buck, basically.
Yes, I think so. I mean, everyone today everyone really wants to get rich in a very short period of time. That's just kind of human nature. So there's always a desire to do that. But of course, it comes with more risk. People want to make a big call and get it right and have a big payoff. But unfortunately, in investing, there's so much uncertainty that getting those big calls right is quite rare and quite risky. And frankly, a lot of people get them wrong, and that's quite damaging. So really, the best way of compounding wealth over long periods of time is to be more patient and have a longer time horizon, rather than trying to swing for the fences and miss every so often.
And we're also told time and again, I mean, we are certainly told to think long term. It's sometimes hard to do that, but we're also told that we have to diversify our portfolio. So what does that really mean?
Yeah, well, diversifying your portfolio is really about this point that the future is uncertain. We can all walk into a casino or roulette table and just put all your money on red or black, and you either win a lot or you lose everything. That future uncertainty really means that just making one big bet and getting it right or wrong is quite dangerous.
Yeah.
So really, it's just telling us to make more bets ultimately. And that sort of thinking can really go through your entire portfolio. But at the very high level, it normally means starting off with asset classes. So people typically invest in equities and bonds and maybe property and commodities maybe. So it's just trying to say to people, don't make one big bet, because the future is uncertain. And no matter how expert you are at anything, there's a reasonable chance that you could be wrong about the future. So make more than one bet and diversify your portfolio in that way.
But does that mean that the more you invest in, so say, for example, you put your money into an index tracking fund, which tracks a whole bunch of stocks and shares, like 700 or so, if it's the FTSE All Share, is that actually ultimately the safest way, would you say?
Well, this depends on perspective, and it's really important, that point, that diversifying your portfolio goes through all the different levels of your thinking. So if you look at your index tracking the FTSE All Share, for example, at the asset class level, you've got all of your money in equities. So if equities don't perform well this year, that's a big problem. So you haven't really got diversity at your asset class level. But if you focus just on equities, well, you do have reasonable diversity in your equity portfolio. You've got 700 stocks, but they're all UK stocks. So you didn't look at overseas. So have you got too much concentration within your equity portfolio? So this sort of notion of diversity, of the future being uncertain, it really can apply at all different levels of your portfolio construction and decision making as an investor.
So in that case, because I thought that Alliance Trust did just invest in equities. So you're saying that you don't. You with yours, you're picking. You pick all sorts: commodities, property, the lot.
No, so Alliance Trust is just an equity portfolio. We focus on global equities. That's intentional. We're not suggesting that people should put all of their life savings into one product, be that Alliance Trust or anything else. We do expect people to own other asset classes. But Alliance Trust focuses on equities because we feel that we are equity specialists and have a differentiated offering to give people in the equity space. So that's why we think focusing on what you're best at is probably more useful to your shareholders than trying to be the jack of all trades and trying to be the best of equities and bonds and property and everything else. Yeah,
that makes sense. But last year, of course, was a torrid year for equities investors, actually for all sorts of investments, let's be honest. But Alliance Trust managed to avoid the worst of the tech rout because I'm guessing because of your diversification. Whereas another fund, Scottish Mortgage, which is heavily invested in tech, seems to have fallen by the wayside a bit. So do you think it was the diversification that effectively saved you?
Exactly, and it is very intentional in the way we build the portfolio. There are products out there, and you've mentioned one, but there are many companies or products which do focus on one specific thing, and that might be growth companies or technology companies. So in that example, yes, they had a superb period of performance, and then obviously more recently a period of a lot more disappointing performance. So how did Alliance Trust avoid the worst of the tech route last year? It was because of the diversity we built into the portfolio. It's this idea of not putting all your eggs into one basket and making more bets. So we have multiple stock pickers in the portfolio. We've got different investors finding different stock ideas in different parts of the market. So yes, we do have some technology companies. We think we've got the best ones in the long run. We'll see if that's proven out. So we do have some exposure, but we didn't have all of our eggs in that basket. We had lots of other things in the portfolio that were doing well last year. So when you look at Alliance Trust versus the peer group, we actually look to be a lot more resilient than some in the marketplace, and compare pretty well to the peer group over that period.
And I'm guessing that, of course, stocks come in, they go out, and potentially we're just talking about tech stocks here, but actual sectors will be reduced and increased. And I'm thinking maybe at the moment the banking sector, for example, is not particularly favoured by your stock pickers.
Yeah, absolutely. I mean, so we're trying to pick the right companies for the long run. We don't typically sort of go in and out of sectors in a big way. Again, it's trying to avoid big single binary bets that can have sort of big positive or negative payoffs. In the banking sector, we didn't have any exposure, for example, to SVB or Credit Suisse. But clearly there's an ongoing thing there that people need to be cognizant of, and it's much broader than simply US regional banks. There's a lot more implications for what does this mean for the market, for liquidity, for interest rates, for broader risk taking. But when our managers are picking stocks, they have to focus on how is this company going to be resilient in the future against whatever the world throws at us. And things like banking crises do happen from time to time. And that's something the world can throw at you. So it's always coming back to this idea of focusing on the right companies, knowing that the future is uncertain, and making sure you're picking the right companies and making good, diverse bets in your portfolio.
Now, of course, I would say this, but it seems that for the ordinary retail investor, investing in funds like yours is frankly a nice, easy way to diversify your portfolio using the intelligence and the time and the effort of stock pickers like yourself. But if you were going to do it yourself, if you're going to say, right, I'm going to create my own fund, the Jasmine Birtles fund, you know, do you have any advice as to how many companies I should concentrate on, you know, to get diversification, but not spend all my time looking through all these companies, seeing if they would actually survive in the long term?
Yeah, so honestly, it's a really difficult question to answer because it varies so much on so many different things. But maybe let's just start at why we do Alliance Trust the way we do, and then we'll go to that. So why we do this the way we do is because we know when individuals try to do it themselves, it actually gets too complex too quickly. So people can manage a few different positions. They can decide how much money to put into equities and bonds and property. Within equities, they can maybe decide to buy a tracker, or maybe they decide to buy a few active funds. But any more decisions than that starts becoming really complex. So the reason Alliance Trust exists and why we think it's actually great for a lot of people out there is we build a lot of this diversity in for you. So you don't have to make all of those decisions. You can let Alliance Trust do it. And Alliance Trust can give you good global equity and diverse exposure. But to this point around, look, what if you do it yourself? Well, we've got around 200 stocks in the portfolio. That's probably enough for diversity. If you buy a global equity index, it could have 2,500, 3,000 stocks. Does that give you any better diversity is a question, because a lot of those indices are pretty skewed to some big US tech companies right now. So there's all that to consider. And of course, the other point is whether your individual retail investor really wants to be picking funds or picking stocks. So you could pick half a dozen funds, for example. But does that give you enough coverage of the world? Are you covering all the different countries, all the different sectors, all the different styles? Are you really finding all the opportunities that might be out there? And half a dozen might be enough, it might not. It kind of depends on which funds you're picking.
Yeah.
So lots to think about for individual investors in there, which I think is why Alliance Trust is hopefully helping people in some way.
Well, exactly, yes, and I think that this is the point of this interview really is to have a look at the benefits of simply investing in a fund where somebody else, a few other people, are doing the work for you, as opposed to spending a lot of time and effort and being Warren Buffett, essentially, studying sorts of companies, which works for some people, but you know, I think for most of us, we just don't have the time or the knowledge, in all honesty. Because I mean, with Alliance Trust, you do have quite a few, as you've mentioned, you have a few people working on it. How many stock pickers do you have? Yeah,
so currently we've got 9, but it's not a fixed number. We typically say 8 to 12 would be normal, but we could have more or less at different times. But around 10 feels about right to us.
And they have a maximum of 20 stocks to pick. Why have you created a maximum for them?
Yeah, so this is really about trying to have our cake and eat it, to be honest, which I know is not really an easy thing to do, but that's really why we do this. So it's those two things together, 20 stock portfolios and lots of stock pickers, so around 10. And that's having your cake and eating it. And what I mean by that is start with the stock pickers. Why do we limit it at 20 stocks when most funds out there would typically hold maybe 40 or 50 stocks or even 100 or more? Well, the reason is we think over the long run, they will generate better returns for investors over very long periods of time. But we don't ask them to focus just on one stock. Back to this point of diversity, we're not asking them to make one bet. About 20 bets is the most they really need to get genuine diversity into that portfolio. You don't need to make 50 or 100. 20 is enough. But it also forces them to really back those bets with conviction. We're not trying to put 0.5% each into 200 stocks from each stock picker. It's 20 ideas, back them with conviction, and hopefully generate superior long-term returns. But then, eating this cake is having 9, 10 stock pickers at any one time. we can actually, but by having more concentrated portfolios, it's easier to combine more of them together. So we can build more diversity at a stock picker level, having more ways of thinking about investing, more different idea generation going into the portfolio. And that combination is the really powerful part of Alliance Trust, which makes it a bit more differentiated versus the peer group.
That's a very interesting way of looking at it. And I'm just thinking that with these 9, there must be quite a bit of, firstly, there must be quite a bit of overlap. They come up with the same ones, but also there must be quite a bit of tension here and there when one's going, no, this is the best one. The other, no, this is, no, I think bit of discussion.
Yeah, exactly. So, if you put them all in a room and ask them to debate a stock, you're going to get some very different opinions, and that could be quite interesting. But I think your point around what happens if they all own the same thing, that's almost everyone's immediate reaction when we talk about this concept. And the reality is the overlap in the portfolio really isn't very high. We've got, I think, about 185 stocks currently. I mean, let's say around 200 generally is a maximum. Probably 10 to 15 of them are owned by more than one stock picker at any given time. And maybe 5 of them or so are owned by more than 2. So it's just not the case that they all end up owning Apple because Apple's a big stock. In fact, we've had 0 exposure to Apple for most of the last few years. So if you do this correctly and invest with stock pickers who are genuinely differentiated in how they think, you get different portfolios and different ideas. Admittedly, if someone did this strategy badly, you would end up with that problem where actually managers weren't that different and they ended up buying the same kinds of things or even the same things. That would be a problem. But in the way Alliance Trust builds it, that's just not an issue.
It occurs to me that I don't know how long ago it was, maybe the 90s, noughties, there were quite a few, a bit like book reading groups. There were stock picking groups, bunch of friends would get together and they do it. Yeah. I didn't do it, but a friend of mine did, and she said she lost money. But it's almost sounds like if you had a bunch of friends who were really on it, they might be able to together come up with a decent fund together. But even that doesn't always work.
Well, I'm sorry for your friend's experience, but it's that kind of idea. There's so much information around today. Everyone's probably bombarded with ideas left, right, and centre of what they should be buying, and of course, it's hard to know. What Alliance Trust does is we go to the effort of picking those stock pickers for people. We think, we spend hundreds, if not thousands, of hours doing our due diligence on these people. It's not just look at the track record and see if it's a brand name that we know, but that's how most people happen to pick funds. We spend a lot of time making sure that these are the best stock pickers of what they do. Now, again, like anyone, we don't get everything perfectly right all the time, but we think, we've assembled a good team here of really, really differentiated stock pickers who are skilled at what they do.
And ultimately, your performance has shown this. And this, when I talk to people about picking a fund, I say, look at their long-term performance. And as you say, Alliance Trust has had a long time to perform, and it has performed well, particularly on the dividend side, which is really not an easy element, I think, of picking stocks and investing. Well, thank you so very much for taking the time, Stuart. It's been really interesting to hear your philosophy and the philosophy of Alliance Trust in its investing. Really good to have you on. And for viewers and listeners who are interested in finding out more about Alliance Trust and how to invest in their investment trust, we have a number of articles on MoneyMagpie.com about them and about investment trusts generally. We also have a webinar coming up on April the 17th, all about investment trusts, which will include somebody from Alliance Trust, and it'll explain how we can invest in them. It's free to join, so just go to MoneyMagpie.com webinars to sign up for that. Thank you for joining us on the MoneyMagpie podcast. Don't forget to share and like and generally just tell everybody about us. You want to. Today's podcast was presented by me, Jasmine Birtles, and you can follow me on Twitter at Jasmine and on Instagram at Jasmine Birtles, or just follow us all at MoneyMagpie on all the social media channels.